So I'm going to continue on Ben's conversation here with rule number 13 on how to fail, which is go unhedged. Today my presentation will be on a new part of the mining industry, which many have been talking about for a few years, but it's suddenly coming to fruition here in 2023 in very exciting developments, which is hash rate derivatives. So going to be going through this presentation in three parts. First, I'll be giving an overview of what derivatives are, how those markets start and why they're needed. Second, kind of talking in practice about how this applies to hash rate and what those contract and market structures look like when you relate that to the mining industry. And then finally, why you should care. What are the hedging use cases? Why does it help miners out? So looking at the history of derivatives, the first ever commodity derivative contracts were started about 170 years ago in Chicago. Basically, at the time, agricultural producers had no ability to lock in revenue certainty. And so they created contracts where agricultural producers could agree upon a price in a future date and deliver their product to market at that specified price. What this did was it gave revenue certainty to these farmers. Previously, they would have to harvest their crops and then go to market and accept whatever spot price was there at the time, which could have been vastly different than the spot price when they decided to make that initial investment into the farm and the deployment into it. So these contracts were formed, buyers took the price, sellers gave that price, and the contract was executed. With these contracts coming to market, that engaged more financial participants into the market. What we saw was when there was revenue certainty for these farmers, a lot more capital providers were now willing to underwrite some of the investment going into this space. So farmers were able to guarantee some level of return for their crops. Financiers were comfortable now giving them debt financing to expand their operations. After this, we started to see quite a few new entrants come into these markets. And that is mostly on the basis of speculators or traders, as we talk about. It's very critical in markets to have people on different areas or different cost curves and risk curves. And so having a robust marketplace needs multiple participants that are using the market in different means. So these traders and speculators, their primary objective is to generate alpha and earn a return trading derivatives, but they really complete the market. Once these traders came in, that's when contracts started becoming standardized. So they went from over-the-counter, bilaterally negotiated between two parties to standardized contracts that you could trade on exchange, higher liquidity, and with it came things like order books and matching engines to facilitate the trades. So it's our view that hash rate derivatives already are and are on their way to this exact process here, where miners historically haven't had the ability to hedge future hash rate. And these markets dynamics are forming as we speak here. So looking at hash rate, the fundamental basis that we consider, and actually one of the reasons I got into this space is because we view hash rate itself as a commodity. I know a lot of people talk about Bitcoin miners as producing Bitcoin. The way we see it, and I believe it is the fundamental area that a Bitcoin miner competes in is they procure power, they procure infrastructure and machines. What those machines do is they run through the SHA-256 hashing algorithm and produce outputs. In that sense, that machine is producing compute power, which is then sold to a Bitcoin mining pool or mined directly to the Bitcoin network. So in that case, compute is the commodity, hash rate is the commodity in which miners are producing, Bitcoin is the medium of exchange in which they're getting paid for their hash rate. And under that kind of guise, the CFTC in the United States, I'm not sure what the equivalent is here in the EU, but these contracts fall under the jurisdiction of the CFTC regulation. So another critical unlock piece to this is defining how are we actually going to trade hash rate. And so we've been spending a lot of time in the past few years coming up with this concept of a value for hash rate. Something that we've quoted as hash price. What this represents is the value that hash rate can generate when applied to the Bitcoin blockchain. In 2013, there was a big innovation in Bitcoin mining pools when Bitpenny came out and invented the pay-per-share payment methodology for miners. It has since evolved to what miners know today as full paper share, FPPS for short. In principle, what this payment methodology does is it allows you to determine the expected value of a unit of compute when applied to the Bitcoin blockchain using only 3 inputs, all of which are on-chain. So what goes into a Bitcoin-denominated hash price is transaction fees, block subsidy, and network difficulty. And with those 3 variables alone, you can calculate how much the expected value of a single share or hash is worth to the Bitcoin blockchain. And so that's what we've been tracking here, and it allows you to start trading some of these assets as the spot value for a hash rate. So starting to kind of shift gears into this derivative contract, I'm sure some of you are familiar with derivatives, some may be a bit more new. Contract, fundamental basis, there's 2 counterparties, one buyer, one seller. They're agreeing on a certain price, a certain volume, and a certain duration of a future asset. Now there's 2 primary ways to settle a financial contract like this. There's physical delivery and there's cash settlement. Physical delivery, pretty self-explanatory. In the case of oil, if you agree to sell somebody 100 barrels of oil in 30 days from now for $60 a barrel, they give you $60 at the end of that month, you give them 100 barrels of oil and they take possession of those barrels. Cash settlement is a little bit harder to wrap your mind around, but it ends up in the same economic outcome. At the beginning of the contract, you decide on a price, say in this case $60 a barrel of oil. At the end of the contract, no actual oil has changed hands. It is just settled between the traded and the settlement price. So if the price of oil at the end of the contract is $80 and you agreed on 60, one side tops the other one up by $20. And this is how the majority of derivative contracts for commodities are traded today, because a lot of trading desks, traders, they don't want to receive physical delivery of those assets. They just want to bet on the underlying price. So looking at the contract that we're offering, and you'll see this across some other products in the market too, there's really 4 components that go into this. Again, pretty simple. First, buyer and seller as the counterparties. Second would be the contract price, which kind of referenced there on the hash price chart. We denominated in the amount of either USD or Bitcoin that a petahash of compute can generate over daytime. But you could denominate it in any form of kind of currency, compute, time period. Next would be quantity of that, obviously denominated in the same, being compute power, and then finally duration. So moving into market structure, maybe I'll start with the sell side here because it's a little bit easier for people to understand. When you think about a miner's business, they're purchasing machines, they're generating income from those machines. We call them inherently long hash price. So currently hash price is sitting more or less around $60 a petahash per day. In the case that went to 120, each of these miners would generate 100% more income. Vice versa, if that went to $30 a day, they generate half as much. So their operations are inherently long. They want hash price to increase. It would benefit them. But that also means they're fully exposed on the downside, which over the past 2 years we've seen can be quite painful. So the way that sellers can engage with hedging instruments is hedging their bets. So they're inherently long through their operations. They need a financial instrument where they can go short and offset that. And so in this case, they would go short a non-deliverable forward contract and lock in a price for their hash rate, say something like $55 per petahash for the next 6 months. There's a number of other participants on the sell side that I've listed here too that are equally tied to hash price and inherently long that use this product. And then of course traders and speculators do too. On the buy side, this is one of the big question marks I think for people, given that the Bitcoin blockchain is the fundamental buyer of hash rate. Really, at the end of the day, the biggest flow for the buy side is going to be speculators and traders. These are prop trading firms, family offices, hedge funds, asset managers. That represents the large portion of Bitcoin derivatives today if you look across like CME flows or Deribit. So that will represent the biggest flow of hash rate derivatives too in the future. Now there are a lot of also natural participants that engage on the buy side. Something like a miner that hasn't deployed yet but wants exposure to hash price and is waiting for their machines. maybe you're a miner and you pay your hosting fee in a revenue split, so your revenue split is inherently short the value of hash rate, and so on. So it's exciting to watch these markets develop and more use cases come out of them. Okay, now moving on to why this actually matters. So first is on volatility. Graphed here on the left, volatility of what people consider one of the most volatile assets in the world, which is oil, right? This is WTI oil. We've seen boom and bust cycles of oil companies in the past. Companies do very well for a couple years, and then obviously the next cycle, it's quite painful. Yet hash price is actually even more volatile than WTI. So what does that mean is that miners are even more so exposed, and it's very hard for them to last economic cycles in which the value in what the commodity they're producing is much less than it was previously. So these instruments give you cash flow consistency and predictability. And one of the really cool underlying benefits of that is your cost of capital. Miners have historically paid a really high cost of capital, sometimes between 15 to 20% for USD denominated debt. And that really hurts your bottom line when you have that big interest payment coming every month. So I'd encourage miners here to talk to their financiers and figure this out themselves. But based on our conversations with financiers and miners, when you can lock in revenue certainty for your operations and you have known numbers for your future revenue, that changes drastically your profile with a financier, and they're willing to give you much better terms, usually on the order of a few % lower interest rate. Next would be valuation improvement. So I'm not sure if any of you read the latest GSR article that came out on this, but I really like the graphic they put through. Not only does hedging improve your bottom line through reduction of interest payments, but it also increases your valuation in public markets. And so there's been a lot of research looking at the volatility of earnings for different industries and mapping that out versus the multiples and how the market views that. And over time, we've seen kind of a direct correlation between companies that have higher certainty when it comes to cash flows corresponding with higher valuation multiples. So, of course, this is all based on publicly listed data of stocks. I know a lot of people here probably run mining operations that are private, but it also means that on the private markets, you will have an impact on the valuation of your company. I think this is a really exciting idea for a couple of reasons. One, in mining, we often talk as if it's a zero-sum game. If one miner benefits, is that another miner's harm? In this case, it's a clear example where if the entire industry hedged more, the entire market cap of the industry altogether and valuations would increase just by increasing our overall revenue certainty. And then last is bear market resilience. I think everyone's been touching on this on stage all day, but the bear markets are vicious in mining. They're quite painful, but we often forget the good times. 2021 was a good example of that. Hash price was trading 400 petahash per day. Miners were making upwards of 80% EBITDA margins, and life was good. There will be times like that again in mining, and the critical piece in mining is surviving until those points. How do you stay alive? How do you make sure you don't go out of business? And you have machines up and running for those times that Bitcoin price does outpace network difficulty growth and you get outsized returns. So playing conservative, I think, is having a long-term oriented view on the industry, a low time preference. And if you're a good Bitcoin miner, hopefully you do have a low time preference and you want to be mining for the next few decades. So that's it for my presentation. Happy to answer any questions anybody has. Ben? Yeah, well, it's a good question because we haven't fully solved it yet. But here's our forward hash price market. So currently our market makers are willing to go out all the way to February. So what this means is currently if you wanted to lock in your hash price up until the halving, you could sell forward hash rate at $52 per petahash per day. We are in the process of getting market makers comfortable with going past halving, but as of now, we don't have pricing after it. I think realistically, people are assuming obviously some difficulty drop. And so on its basis, block subsidy decreasing by 50%, mining revenue by 48% after TX fees. What's the offsetting difficulty adjustment? And then, yeah, just basically volume or like time weighting that across the thing. So I think we'll see a sharp decline there once we start getting into April and May next year. Yeah.
How do you find improved financing through, we sell insurance for miners, and we often get approached from people who are, because they're financing it, require insurance on the mining equipment. Do you find that having other risk hedges doesn't necessarily have to be insurance on the equipment? Does that help at all in terms of kind of better pricing or better returns?
Is the question like, does insurance help with financing rates? Yeah. Yeah, definitely. At least, so we've personally done 2 ASIC financing deals, and I've seen a lot others occur through mostly like crypto native financiers. And in every one of those deals, you need insurance on your machines, or else be pretty dangerous.
Hey,
Yeah. Does your mic work?
there it is. Hey, are there any decentralized exchanges to trade hash power derivatives that you know of?
So I think Ryan presented from LEVERTON yesterday. There's definitely a name you should check out in the space. And then, to my understanding, there's a couple others like Alchemia. So yeah, I think there's going to be a place for decentralized exchanges or peer-to-peer hash rate, both cash out and physically delivered in the future. Again, this industry is pretty nascent, but it has a very high growth rate. So I'd keep an eye on those names as they develop.
What were those again? LEVERTON and?
LEVERTON and Alchemia.
All right. Thank you so much, Ethan. Ah!